Hi, everybody, and welcome back to video number 4 in chapter 17. And when we left off, we were looking at transaction price allocation example. Here, Travis Company enters into a contract with a customer to sell products Alpha, Bravo, and Charlie in exchange for $100,000. Travis Company regularly sells product Alpha separately, and therefore the standalone selling price is directly observable at $50,000. The standalone selling price of product Bravo is estimated using the adjusted market assessment approach and is determined to be $30,000. Travis Company decides to use the residual approach to value product Charlie, as it has confidence that products Alpha and Bravo are valued correctly. So, how would Travis allocate the selling price to products Alpha, Bravo, and Charlie? Well, pretty easily seen here. Uh, Product Alpha is at 50,000, product Bravo is at 30,000, and the difference between the 100,000 total and products Alpha and Bravo is $20,000. The residual approach. Pretty easy there. Okay, here we'll take a look at multiple performance obligations. The Lonnie Company enters into a contract to build, run, and maintain a highly complex piece of electronic equipment for a period of 5 years, commencing upon the delivery of the equipment. There is a fixed fee for each of the build, run, and maintenance deliverables, and any progress payment are made non-refundable. It is determined that the transaction price must be allocated to the three performance obligations: building, running, and maintaining the equipment. There is verifiable evidence of the selling price for the building and maintenance, but not for running the equipment. So, what procedure should Lonnie Company use to allocate the transaction price to the three performance obligations? And here, the performance obligations relate to building the equipment, running the equipment, and maintaining the equipment. Lonnie can determine verifiable standalone selling prices for equipment and maintenance agreement. The company can then make its best estimate of the selling price for running the equipment using the adjusted market assessment approach or the expected cost plus margin approach. Lonnie next applies the proportional standalone selling price method at the inception of the transaction to determine the proper allocation to each performance obligation. Once the allocation is performed, Lonnie recognizes revenues independently for each performance obligation using regular revenue recognition criteria. However, if on the other hand, Lonnie is unable to estimate the standalone selling price for running the equipment because such an estimate is highly variable or uncertain, Lonnie may use the residual approach. In this case, Lonnie uses the standalone selling price of the equipment and maintenance agreements and subtracts these prices from the total transaction price to arrive at a residual value for running the equipment. Okay, in another example, Handler Company is established manufacturer of equipment used in the construction industry. Handler's products range from small to large individual pieces of automated machinery to complex systems containing numerous components. Unit selling prices range from $600,000 to $4 million and are quoted inclusive of installation and training. The installation process does not involve changes to the features of the equipment and does not require proprietary information about the equipment for the installed equipment to perform to specifications. Handler has the following arrangement with Chai Company. 1. Chai purchases equipment from Handler for a price of $2 million and chooses Handler to do the installation. Handler charges the same price for the equipment irrespective of whether it does the installation or not. Some companies do the installation themselves because they prefer their own employees to do the work or because of relationships with customers. The installation services included in the arrangement is estimated to have a standalone selling price of $20,000. Number 2, here, the standalone selling price of the training session is estimated at $50,000. Other companies can also perform these training services. And number 3, Chai is obligated to pay Handler the $2 million upon delivery and installation of the equipment. Number 4, Handler delivers the equipment on September 1, 2025, and completes the installation of the equipment on November 1, 2025. Transfer of control is complete after installation. Training related to the equipment starts once the installation is completed and lasts for 1 year. And the equipment has a useful life of 10 years. So, Alpha, what are the performance obligations for purposes of accounting for the sale of the equipment? And Bravo, if there is more than one performance obligation, how should the payment of $2 million be allocated to the various components? Well, as we look at the solution for Alpha, Handler's primary objective is to sell the equipment. The other services, installation and training, can be performed by other parties if necessary. But as a result, the equipment installation and training are all 3 separate products or services. Each of these items has a standalone selling price, and each is not interdependent. Bravo here, the total revenue of $2 million should be allocated to the 3 components based on their relative standalone selling prices. In this case, the standalone selling price of the equipment is $2 million. The installation is $20,000 and the training is $50,000. The total standalone selling price, therefore, is $2,070,000. So we'll allocate the $2 million as shown by taking these respective percentages here and allocate them to $2,070,000. And that will result in $2 million of total as what we actually received in revenue. Okay. Now, recognizing revenue when each performance obligation is satisfied. The company satisfies its performance obligation when the customer obtains control of the good or service. Pretty straightforward there. A change in control indicators. 1, company has the right to payment for the asset. 2, the company has transferred legal title to the asset. Number 3, the company has transferred physical possession of the asset. Number 4, customer has significant risks and rewards of ownership. And 5, the customer has accepted the asset. So we're going to recognize revenue from a performance obligation over time by measuring the progress towards completion. So number 1, the method for measuring progress should depict transfer of control from company to customer. And then number 2, the objective of methods is to measure the extent of progress in terms of costs, units, or value added. All right, recognition over time criteria. So our number one criteria was that the customer receives and consumes the benefits as the seller performs. That's an example would be routine or recurring services such as cleaning services. Number two, the criterion is the customer controls the asset as it is created or enhanced. Here, we're building an asset on the customer's site, for example. Number three, the company does not have an alternative use for the asset created or enhanced, and either alpha, the customer receives benefits as the company performs, and therefore the task would not need to be re-performed, or bravo, the company has the right to payment, and this right is enforceable. Example would be an aircraft manufacturer builds specialty jets to a customer's specification such that only the customer can use it. Okay. Timing of revenue recognition example. Here, the Gomez Software Company enters into a contract with Hurley Company to develop and install customer relationship management software, CRM. Progress payments are made upon completion of each stage of the contract. If the contract is terminated, then the partially completed CRM software passes to Hurley Company. Gomez Software is prohibited from redirecting the software to another customer. So the question is, at what point should Gomez Software Company recognize revenue related to its contract with Hurley Company? And the solution is that Gomez Software does not create an asset with alternative use because it is prohibited from redirecting the software to another customer. In addition, Gomez Software is entitled to payments for performance to date and expects to complete the project. Therefore, Gomez Software concludes that the contract meets the criteria for recognizing revenue over time. All right, so in summary, in step one here, we identify the contract with the customer. The contract is an agreement that creates enforceable rights or obligations. The company applies the revenue guidance to contracts with customers. Number two, we identify separate performance obligations in the contract. Here, the performance obligation is a promise in a contract to provide a product or service to a customer. A performance obligation exists if the customer can benefit from the good or service on its own or together with other readily available resources. And the contract may be comprised of multiple performance obligations. The accounting for multiple performance obligations is based on evaluation of whether the product or services is distinct within the contract. If each of the goods or services is distinct but interdependent and interrelated, these goods and services are combined and reported as one performance obligation. And number three, determining the transaction price. The transaction price is the amount of consideration the company expects to receive from a customer in exchange for transferring goods or services. And in determining that transaction price, the company must consider the following factors. 1, variable consideration. 2, time value of money. 3, non-cash consideration. And 4, consideration paid or payable to the customer. That looks like a good place to stop this video. And when we continue, we'll continue on with step 4 summary. Until that time, bye for now.